Today we're talking about 7 smart ways to earn interest. Let's get started. 1. High-yield savings accounts. The first and easiest win, high-yield savings accounts. If you're still using a traditional savings account, you're missing out. Online banks now pay around 4% to 5% interest, hundreds of times more than most brick-and-mortar banks. These accounts are perfect for your emergency fund or money you might need within a few months. They're safe, easy to open online, and fully FDIC insured up to $250,000 per depositor. Let's say you keep $10,000 in one of these accounts earning 5%. That's $500 a year earned passively with zero risk. The only real downside? You can't expect stock market level returns. But as a safe place to park cash, this is a must-have. 2. Certificates of deposit, CDs. Next, let's talk about certificates of deposit, or CDs. A CD is a savings product where you agree to lock up your money for a set period, usually from a few months to a few years, and in return, the bank gives you a higher interest rate. Right now, you can find CDs paying 5% to 6%, depending on the term. The longer you lock in, the better the rate. The catch? If you take your money out early, you'll pay a small penalty. That's why many people build what's called a CD ladder, splitting money into multiple CDs that mature at different times, giving you regular access to your cash while keeping great rates. Like savings accounts, CDs are FDIC insured, so your money stays protected. If you want a guaranteed return and don't need the cash right away, CDs are a smart, low-stress option. 3. Bonds. Let's move into something a bit more advanced but still safe, bonds. When you buy a bond, you're lending money to a government or a company. In exchange, they pay you interest, usually every 6 months, until the bond matures. There are 3 main kinds. Government bonds, such as U.S. Treasuries, the safest option. Corporate bonds, issued by companies, slightly riskier but offer higher yields. Municipal bonds, issued by cities or states, often tax-free, which makes them great for high-income investors. For example, earning 4% tax-free could be the same as earning 6% on a taxable investment. You can buy individual bonds or invest through a bond fund, which spreads your money across hundreds of issuers for safety. Bonds won't make you rich overnight, but they provide steady, predictable interest income and balance out riskier investments. 4. Money market accounts. A money market account is like a mix between a savings and a checking account. It usually pays interest similar to a high-yield savings account, around 4% to 5%, but gives you a bit more flexibility. You can write limited checks or use a debit card, depending on the bank. Money market accounts are great for people who keep large balances and want easy access while still earning good returns. Some brokerage firms, like Fidelity or Vanguard, also offer money market funds, which invest in very short-term, low-risk securities. These are often insured through the SIPC, up to $500,000, rather than the FDIC. They're perfect for anyone who wants their cash to stay liquid but not lazy. 5. Peer-to-peer lending. Now let's talk about something more modern, peer-to-peer lending. This is where you lend small amounts of money to individuals or businesses through online platforms like Prosper, Lending Club, or Ground Floor. You earn interest as they pay back the loan, usually between 7% and 12%, depending on risk. The secret to success here is diversification. Instead of lending $1,000 to one person, you might lend $25 to 40 different people. That way, one default won't hurt you much. It's higher risk than a bank account, but also higher reward. You're basically becoming the bank, collecting interest payments and reinvesting them over time. Start small, learn the process, and you could build a steady stream of passive income this way. 6. Private notes and real estate loans. For investors who want more control and potentially higher returns, there's private lending, also called investing in notes. This means you lend money directly to someone, often for real estate, and earn interest in return. These loans are typically secured by property, which means if the borrower doesn't pay, you could take ownership of the asset. Returns here can range from 8% to 15%, depending on the deal and level of risk. But this is where due diligence matters. Work with experienced borrowers, use legal contracts, and make sure the loan is properly secured. If done correctly, private lending can offer great returns while still being backed by real, tangible assets. 7. Syndications and private funds. Finally, there are syndications, pooled investment funds managed by professionals. In a syndication, investors combine their money to fund large projects like apartment complexes, storage facilities, or loan portfolios. You don't manage anything, the fund's operators do all the work, and you simply collect interest or cash flow, usually around 8% to 12% annually. It's one of the most passive ways to earn income, but it does require trusting experienced operators and understanding that your money may be locked in for a few years. Syndications and private funds are excellent for diversification once you've covered your bases with safer, more liquid accounts. Wrapping it all up, let's quickly recap the 7 ways to earn interest on your money. High-yield savings accounts: easy, safe, and perfect for emergencies. Certificates of deposit, CDs, fixed terms, guaranteed returns. Bonds: steady, predictable interest. Money market accounts: flexible access with solid rates. Peer-to-peer lending: higher returns through online platforms. Private notes and loans: high yield backed by real assets. Syndications and funds: fully passive, professionally managed interest income. The key is to mix and match based on your goals. For example, keep short-term cash in high-yield savings. Use CDs for medium-term goals. Add bonds for stability. And as you grow more comfortable, explore peer-to-peer lending or private funds for higher returns. You don't have to take big risks to build wealth, you just have to make sure your money never sits idle. If you enjoyed this video and learned something new, hit like, subscribe, and drop a comment. Remember, you work hard for your money, so it's time your money starts working hard for you. Thanks so much for watching. See you in the next one.